Good morning, everyone watching live on BAM YouTube. We are in Las Vegas finishing out the week, the last day here. Let me know in the comments which market you are tuning in live from. The hot sheet covers what you need to know about the real estate industry in a 24-hour time period. On today's hot sheet, I will cover January's job market, Wells Fargo layoffs, and this winter's emerging housing markets. Today is Friday, February 3rd, 2023, and the hot sheet starts now. We are officially closing out the fourth full week of the hot sheet, our first remote week. Villanova on Monday, thumbs up if you were with me in Villanova. Tuesday in Naples, thumbs up if you were watching the hot sheet on Tuesday. And the last 3 days here in Las Vegas. We're not only surprised that we've pulled this show off for 4 straight weeks, we're also surprised that you all are getting so much value out of it. We really appreciate that feedback, but we're surprised we pulled off this remote week. If you're surprised as us, let me know in the comments. We're really looking forward to just continuing to do this show all the way through 2023. You know, when you start a new show like this and it's live every single day, that the markets are open Monday through Friday at 9:30 a.m. Eastern, at 6:30 Pacific time, and it's live. It's truly live. You guys saw it yesterday when room service came in. We're like, I don't know. We're going to have to test this. This may be something we cancel in 4 weeks, but because of the response, because of the daily downloads, which is available every single day, that gets updated every single day, so you can grab these charts and these sources that we're using in this show. Because of all of that, we're like committed here in 2023 all the way through. So thank you. All right, let's get into it. Payrolls news, job news, JOBs was explosive today, Friday morning. Payrolls increased 517,000 in January, crushing estimates. The estimates were 187,000. Nobody saw this coming. Okay, hey, we think job report tomorrow is going to beat estimates of 187,000. We expect that to, maybe be 227,000, something like that, right? I'm just throwing a random number out there, somewhere in the low twos. Nope, it was 517. Nobody could even predict something like this. This is the January jobs market. This is speaking to how much demand there is for companies, especially in that 215 employee level. And we'll talk about that earlier on the hot sheet. That's where most of these hires are coming from. The unemployment rate fell to 3.4% versus the estimate for 3.6%. That's the lowest jobless level since May 1969. We didn't make that date up here at BAM because Eric likes the number 69. That's straight from CNBC. May 1969. That's insane. Lowest unemployment rate in forever. Leisure and hospitality added 128,000 jobs to all sectors. Other significant gainers, business services, government, and healthcare. We're going to show a chart, breaks that down, and you're going to be able to download that in the monthly download. Unemployment picture in 2023, stunningly strong. When you hear that, it's like, okay, that's a good thing, right? People are getting employed. People are getting jobs. There's, a lot of concepts that relates that to we're maybe in a really good economy, a recovering economy. But let's remember what Jerome Powell said on Wednesday. We talked about it on yesterday's hot sheet. If you want a full breakdown of that, go to the replay for yesterday's hot sheet. He said there's a chance unemployment remains strong and that we get back to 2% inflation. Remember, the Fed is committed to 2% inflation. They're going to do whatever it takes to get to that number. They've said it repeatedly. It's something he said he will not walk back on, whatever it takes. He says that chance, though, it's not likely, but it's possible. It's not likely. Okay, so unemployment is not only strong here in January, It's abnormally strong. It's ridiculously strong. How do we think about that for its impact on housing? I'll tell you how I think about it. I think the next 6 months, with this kind of job growth, with this steady employment level that we're at, real estate's going to be fine. If you're a real estate advisor, if you're an agent, and you're working with home shoppers and buyers and clients and sellers, they're going to be active in the first 6 months. But we're going to see what the Fed does in March. We're going to see what the Fed does in the meetings preceding that. And if they continue to put extreme pressure on the economy, deliberately pushing it into recession, eventually you will see these job numbers come down. I do believe quarter 3 and quarter 4 are much more uncertain for real estate agents, for everybody in the real estate industry, as opposed to quarter 1 and quarter 2. It's take advantage time if I'm one of those folks. The unemployment rate not only fell to this lowest level since 1969, but labor force participation rate edged higher to 62.4%. I believe that number right there is actually low, because a lot of people are working, some type of media job. They're working some job that's, 3-4 different jobs online in their house that's not technically reported in traditional ways as it relates to this labor force participation. The broader measure of unemployment that includes discouraged workers and those holding part-time jobs for economic reasons also edged higher, 6.6%. All right, let's take a look at where these jobs specifically came from. This might give you a better indication into your local market, what's happening with, if you're in a specific industry, what's going to happen with the next couple quarters, the next year in your local market. Here's where we added jobs. If you're in a mining and logging market, haven't added much jobs there. If you're in a market where construction, you're adding. Construction is adding. Okay, some of the big ones here: professional business services. Okay, huge growth there. Private education and health services. We've had growth there. This is just January 2023. Leisure and hospitality. Okay, if you're in a market that is well-traveled, short-term rentals, that type of market, we're definitely seeing job growth in January in those markets. People are continuing to travel at extreme rates, right? Look at some of those airline numbers right now. Government, government keeps talking about inflation, but they never cut back. I can't figure that one out. Information dropped down, right? Technology, we know technology's had the most layoffs of anybody the last 6 months. And that was reflective in January as well. Here we go. Here's where people are losing jobs. Again, technology in 2022 by far outpaced any other industry. So this is for the year of 2022. Automotive, healthcare, surprisingly, also a top 5 industry for job layoffs in 2022. We saw the other number where healthcare adding in January 2023. I think we can all agree we'd love to see healthcare continuously adding. We need great healthcare people in America here today. Financial, okay, had layoffs, and we saw that in January 2023, those jobs started to come back. Professional and business services right here. So for January, they got a lot of that back. They did have a pop in a different segment, financial activity specifically. And then services also saw those layoffs, but we just spoke about the hospitality and leisure services having really explosive growth in January. So if you're one of those markets, take that into consideration, right? If you don't have this explosive job growth, maybe you're one of those markets that we've been talking about on the hot sheet where prices are actually coming down. Let me know in the comments what jobs look like in your market. What do they look like right now? Are you seeing a lot of these smaller companies, like we talked about the Wall Street Journal, 250 employees or less, out there hiring at an extreme level? Are you seeing big layoffs at the top, or are you seeing just a steady labor market? What are you seeing in your market, and where are you from? Here's just another chart you can grab down in our monthly downloads. Daily downloads. Thank you, Bobby. Daily downloads. These are monthly job creation in the U.S. I was looking at monthly. Thinking daily downloads. All right. January 2022 through January 2023 shows you that this number here in January was just well above anything expected. This is the trend line that they expected. They didn't expect to come out of the gates in 2023 when everybody's bracing for a recession and see more than double what all the talking heads were saying was going to happen when this report came out this morning. So again, your market for the next 6 months react very positively to this. And we're seeing a spring market in many towns and cities across America that's reflective of that. People have, a good feeling about their job. They're pretty, happy with where they're at, and they've got the money to spend. They are spending it on housing in some markets and in some situations. That isn't going to listen to the Hash yesterday. They are absolutely encouraged. They need substantially more evidence. This evidence today would go against the economy slowing at the pace that they want to see. And so I will predict it right now. We'll see another federal rate hike in March when they meet. They're going to try to deliberately slow this thing down and do whatever they can to potentially bring this cool this job market off. There's a lot of belief, and I'm in the camp, right, of let's not deliberately, if we're going to a recession, let's not deliberately just disrupt these jobs to get. Everybody's expecting this recession, and maybe they're navigating it, so uniquely, something we've never seen, where you have jobs strong, and we're going to bring the economy down at the same time and have this soft landing, right? We've been anticipating recession for 12 months. So everybody's ready for it. So I'm not going to take that out of possibilities either. I just don't believe putting people out of work is going to be our path to a faster recovery. I think that would be a 2+ year recovery if we have massive layoffs across this country. Let me know in the comments what you think about that. Speaking of layoffs, Wells Fargo cuts 140 jobs as it exits the correspondent channel, being mortgage business. We talked about that a few weeks ago. Wells Fargo getting out of mortgage. They cut up over this 100 jobs in the mortgage division following this exit. A worker adjustment and retraining notification, WARN, filed in Illinois on January 18th, outlines the bank's plan to impose layoffs that will impact these 140 employees. The workforce selection started on Tuesday at Wells Fargo office in Springfield. Right. So if I'm local to Springfield, this is something I want to take into consideration. Right. Do I want to be the media company of Springfield if I work there and put out a lot of content around this news? The answer is yes, 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 I do. I want to be the person reporting on that. I want to be the person connecting with those 140 employees, or at least 10% of them, and having a conversation from a real estate agent. The channel relies on small originators, purchase focus, right? They're not going. We talked about this. They're not going to be going into purchase loans anymore. They're going to service their high-end wealth clients and some diverse communities. Everything else they're selling off. So they're selling off the mortgages that they own. It's also a really good lesson learned for people thinking, hey, I'm going to start mortgage. I do 300 transactions a year. I'm just going to start mortgage because it's easy. Wells Fargo was in some pretty big numbers. Okay. Their total originations last year declined 47% to $108 billion. Okay. So they're not just like they weren't dabbling in mortgage. And I hear a lot of people, the sexy thing is to dabble in mortgage, to start a mortgage business. I'd caution people on doing that. Create the partnerships that actually support your main business, might actually be more profitable for you as it relates to mortgage. Okay, here's some winter markets that are emerging and that you want to pay attention to if you want to invest in a market because yours is too high and it doesn't give you that median or below median price point. Or maybe somebody's relocating and they need to know about these markets, or maybe you're in this market and you didn't realize that Wall Street Journal is saying these are your top emerging markets for 2023. This is according to Wall Street Journal and Realtor.com, the top 20 emerging housing markets for the winter of 2023. This was released just this week. None of the 20 markets are in the pricey West Coast region. Okay, so if you are on the West Coast, you're going to want to spin this a different way, right? Maybe you're having this conversation with the people that are exiting. But if you're not in the West Coast, this is definitely something that could be in your email newsletter. The top 20 emerging housing markets in the winter of 2023 are Lafayette, Indiana, 299,900. If you're watching along right now, you see these numbers are all mostly below. There's a few that are above, but mostly below the median price point in America today. These are real opportunities because I believe every single one of these markets on this list will eventually level up over the next, call it 5, maybe 7 years to the median price point in America. So there's real opportunity here as we sit at a median price point over 350,000, 370,000. Lafayette, Indiana at 300. Fort Wayne, Indiana, 270. Elkhart, Indiana. All right. Indiana's an opportunity there. 250. Topeka, Kansas, 225. Johnson City, Tennessee, 376. Columbia, Missouri, 340. If you're in any of these markets, hit the thumbs up and let us know which market in the comments. Kingsport, Tennessee, 300. Savannah, Georgia, 400. Surprised to see Savannah. Savannah, Georgia is pretty expensive. I don't know what you get for 400. If you're in there, let me know. Savannah's a small, it's cool, I'll say, small, I'll say, but surprised to see Savannah in there. Columbus, Ohio, 330. Across Wisconsin, a lot of Midwest, right? Midwest, those northern mid states. Manchester, New Hampshire, 500,000, and is emerging market. Seems a little luxe to me. Burlington, North Carolina, 350. Portland, Maine, 550. That's ridiculous. That shouldn't be on there. Knoxville, Tennessee, 429. Speaking of some Knoxville agents this week, and they're like, hey, we're always competing with Chattanooga to be like that number 2 to Nashville, but they're attracting business, and so that one doesn't make sense. The price point's a little high though for it to be emerging to me. South Bend, 275. If you're from South Bend, I'm sorry, but the only thing people like is Notre Dame. They're not highly impressed with South Bend, but it's on the list. I'm impressed if you're doing short-term rental because they love their Notre Dame football there. And then you've got the rest. Okay, Springfield, by the way, Missouri's on that list. Springfield, Illinois, also on that list at 162. So incredible deal there. You can look at all those in our daily download. We put all our sources in there. It's also at nowbam.com. So a lot of Indiana, if you're in Indiana, you've got huge opportunity to attract outside investors. There's still a lot of cash in this market. There's still a lot of investors. It's definitely cooled off from 21 and 22. A lot of investors, and I'm sure they would like to know where they can get below median price point homes. Dawn says hiring mid-level, high-level professionals, relocation coming in as new companies bring HD headquarters here. Also hiring service industry. Dawn, where are you? I'd love to know where you're at. In Indiana? Okay, maybe you should start. Dawn, let us know which market you're referring to there, because I'd love to know all them. Just out of a little bit of data, I'd love to know which markets have really strong job growth, right? And what do you think that's going to do for your housing market? What is that doing to your housing market here in early January? Okay, the job market and the news we had yesterday about the mortgage interest rate. I don't know if you're following me on Twitter at Byron Lazine, but I was kind of doing a little dance. Hey, we're finally, for the first time in seemingly forever, right? Certainly since September 12th, to be exact, of last year, we're at a 5 handle on the national average mortgage rate. Okay, so a 5 handle means yesterday we were 5.99, according to Mortgage News Daily. It should have been a day that buyers locked in, because this news with the job growth, this is what I mean by the Fed doesn't like this job growth, and the markets know that the Fed doesn't like it, and they're reacting to that. Look at what the 10-year did this morning. 10-year is up. It was up over 3.5 before we started the show. We're at 3.496. I mean, it's up almost a full basis point. CNBC saying over 3.5 right now. Yesterday we hit this beautiful number of 599 on the 30-year fixed. My anticipations were right back up to that 6.1, or maybe even, somewhere around there in the 30-year fixed. It's going to jump right back up today because the 10-year jumped, because the job market is so strong. And these listen, Dow futures are down. I don't know. Let's see where they're at right now. Dow futures, if they're still down after the, yeah, Dow's down almost 100 points. S&P's down 25 points. NASDAQ's down 100 points. Everything's red because this job market is so strong and they know what the Fed's going to do to react. So we'll keep watching it. Next week, week 5 of the hot sheet, we'll keep giving you all the information so you don't have to pick apart all these different sources. We've got the daily download below so you can have it in one condensed version. Really appreciate everybody that has reached out, everybody that I saw here in Vegas that's watched the hot sheet in the comments. Really appreciate all of your feedback. It's giving us the energy and the push to make this show happen no matter where we are, no matter what time zone, no matter what's going on. And it's making us better professionals here at BAM. So thank you. We'll be back Monday for week 5. Today, premiering at 2 p.m. We have the Knowledge Brokers podcast. And we're going to go deep on a lot of this stuff that we talked about here on the hot sheet this week. So make sure you go over to YouTube at Knowledge Brokers podcast. Subscribe to that channel so you don't miss that. We're going to be doing that show premiering at 2 p.m. See you guys next week. Have a great weekend. Till then, toodaloo.